Hi, and welcome to this webinar on forecasting. My name is Jorge Rincanino. I'm a manager at Porty Brown. I work in our Elevate 365 department that focuses on outside accounting services. I mainly focus on CFO level services, mainly financial planning and advisory services. So that's what I do. We're going to go through quickly on the agenda for today. So today we're going to go over these items here. What is financial forecasting? What's the difference between a forecast and a budget? The different types of forecasting. What are the first steps into doing forecasting? Best practices, the benefits of forecasting, and then the forecasting cycle. And then we have 2 case studies that we'll go through. And then at the end of the webinar, we will open it up for questions and answers. So before we go to our first item, we're going to do a polling question. So the polling question you'll see here, which of the following best describes how you currently plan your business's finances? So A is I utilize both a budget and a financial forecast. I use a financial forecast but don't maintain a formal budget. I use a budget but haven't created a financial forecast. And then the last one is I don't currently use a budget or a forecast for financial planning. So we're going to let people answer those questions. And then we're going to kind of see the poll results just to see where everyone is at on the webinar. Just going to wait a little bit more. Okay. So I'm just going to move on. We're going to look at our poll results right now. Okay. So there's a good amount of people here that says I'm utilizing both a budget and a financial forecast. And then the other big majority of people say I don't currently use a budget or a forecast for financial planning. The next one is I use a budget but haven't created a financial forecast. So my expectation was to see people in this bottom section here, this bottom answer, and then probably that third answer where I use a budget but haven't created a financial forecast. That's pretty common when I'm talking with clients. So the first kind of question is, what is a financial forecast, right? So the financial forecasting is the process of estimating future outcomes for your business using a combination of historical data, which is typically prior year data or rolling 12 months, or using assumptions about future events, so sales growth and expenses. So you have to use the combination of the two, both your historical information and as well as your assumptions of future, to really help you anticipate outcomes of what's going to happen in the future and make proactive decisions. That's the big key in financial forecasting. Think of it as, what's the weather like going to be in the next 7 days? Historically, this week of August, it might be, 70 degrees out. Using that information and using out the information that, is happening around us. That's a little bit more relevant to see where things are going to kind of fall. So the next kind of question to ask is, what's the difference between forecasting and budgeting? So forecasting is dynamic. You're typically updating this regularly on a monthly cycle. You're adjusting based on new information. New information could be, either getting additional revenue, jobs, or contracts that are coming in the door, or unfortunately on the other side would be losing any of that revenue. Additionally, you're really focusing on what is likely to happen within the next couple of months. So you're trying to see where the financials are, where's the business going to be happening in the next couple of months, what's likely going to happen, and it's used for real-time decision making. So you can say, hey, I'm here at the end of the month. I want to make these decisions based off of where I'm going to be going and where I'm currently at. On the other side of that is budgeting, which is very static. It's typically set annually before the year begins. It's based on fixed assumptions. So typically, in budgeting purposes, they will look at revenue and say, well, revenue is going to go up. We expect revenue to go up 5%. This is what we're going to have all our expenses to, and this is kind of the different months that we're going to have it. So it's based on fixed assumptions, and you're focusing on what you want to happen. So this is, a time where you're saying, I want, if my net income is going to be this amount, this is what my top line needs to be. So you're really focusing on what you want to happen, and that can change within a month, that can change within 2 months, and that's where it becomes just kind of like pie in the sky, that you're just budgeting that piece out. But this is really used for goal setting and control. So if I think that this is going to happen within the financial year, you can set up those goals and to hold your staff accountable based on, using historical information to create that budget. This is the revenue we're going to get. This is how we're going to control our expenses to get that desired outcome of, either net income or balancing to zero to make a profit. So that's the difference between forecasting and budgeting. We're going to go into kind of the first steps into forecasting, because it is a different mindset compared to budgeting or just doing day-to-day accounting. So the first step that you need to do in order to start even the forecasting process is that you need to ensure your accounting is current. You need to set a really good foundation of the information that you're pulling from your systems in order for you to forecast. If you do not have strong financials that are current, meaning you've reconciled key accounts, everything ties out on the balance sheet, you're not building your house on a strong foundation. You're not building your forecast on a strong foundation. So that's probably the first step. That's the most important when forecasting, is making sure that the data that you have in your accounting system is current and up to date. The next thing you have to do is really adopt a growth mindset and really ask the questions, what do I need to get to the next step? This is kind of out there in terms of different things, different approaches that you want to take, but you really have to ask yourself as the business owner, what am I going to do to get to the next step? And sometimes you don't have that answer, and that's why it's always nice to work with either your CPA or someone else to kind of help you discuss different steps to move forward. A lot of the times when I'm talking with clients, they have an idea in their head, but they haven't put anything pen to paper. They just have this idea. And so adopting that growth mindset of what can I do to make my situation better is really important. And so where that comes practically from going from that growth mindset to really understanding, what's your key revenue and cost drivers. So, revenue is kind of what drives the profit and loss. And so you really have to understand what do you need to do in order to generate that revenue, right? So how many units or how many clients do I need to do? How many projects do I need to sell in a period? And then on the flip side, you also have to know what the costs are, right? So you have to know what your sales pipeline is in terms of how likely am I going to be able to close these clients if you're a project base, if you're a manufacturer, how many units do I need to sell, and understand the cost of goods sold. So having really strong fundamentals of, hey, I sell this is what my costs are, this is what my net income or my margins are going to be, is really important on that piece. And if you haven't gone through that practice or that example before, that's where you really kind of go back to the fundamentals of what's really driving your business. And then the other piece of it would be understanding fixed and variable costs, which we talked about a little bit. So variable costs, if you're like a manufacturer, would be your cost of goods sold. So if I produce more, my cost of goods sold are going to be higher, but then we have our fixed costs, which sometimes can be payroll. Most likely it would probably be rent. So those fixed costs and understanding, well, how much is my rent per month? These different things that kind of add up, that regardless of how much I sell, is going to be the same month in and month out. So the next thing that we know after talking about kind of like the first steps of forecasting is what kind of forecast do we want to do, right? So you can do a profit and loss forecast, which, I kind of described in the previous slide, where you're talking about revenue, how much is your revenue going to come in, your expenses to forecast, net income over time. And a lot of these kind of build off of each other, right? So in order for you to kind of do a cash flow forecast, you really need to do what a profit and loss forecasting first. And so this would predict, inflows and outflows based off of your income. So you would go there. The next step would kind of be the balance sheet and the balance sheet forecasting, which would incorporate all two before that, the profit and loss and the cash flow, which would kind of show you your financial position. And this is kind of where, at the end of the day, you boil everything down and say, where's my cash position going to be at? Who do I owe? Who owes me money? That final piece of the puzzle is the balance sheet forecast. So if you include all those three, typically that would be the three-way forecast. And when you're forecasting, you really want to do all three for you to see the entire piece of the puzzle. You can't just do one and get as much information out. You really need to do all three, and they all kind of flow into each other in order for you to get the most out of it. So I'm going to talk about, kind of best practices when doing forecasting here. You want to focus on a 3-month forecast. Typically, that provides you a clear visibility without feeling overwhelmed or complicated. It's a shorter time span, so there's greater accuracy in what's going to happen in the next 3 months. And then it's really actionable as far as what you can do within that 3-month time frame. Things happen quickly and things change quickly, and looking at that kind of like 3-month forecast allows you to kind of be agile and make decisions, make decisions timely, and then react to them, before they happen. One of the big things that I kind of preached in the first step is making sure that you update your monthly books. You update the forecast monthly after the books are closed. So trying to set a routine to review and revise your forecast to keep it current and based on real performance. So this is not a one and done. I'm going to do my forecast for 1 month and not do it for a couple different months. You always kind of want to have that pace of my financials are closed, my books are closed. I reviewed the financials, and then I'm going into that forecasting mindset. What are the next 3 months going to look like? What are my revenues going to look like? What are my expenses going to look like? Is there anything that I want to improve on? Is there anything I want to invest in? Is there something that's coming down the pike that, might hurt my business in some way, right? And the third tip here for best practices is to keep it simple and driver based. So you want to focus on the big items, right? Focus on revenue, focus on the costs that generate the revenue. You shouldn't really be concerned of, hey, am I going to buy $100 worth of paper supplies 2 months from now, 3 months from now? That's not the point of it. You do want to, forecast out, your rent, your payroll, some of these bigger items. But small items that don't really impact the profit and loss that much, I wouldn't really focus on that. So you just kind of want to keep it simple, really focus on, what as far as the revenue coming in and the expenses going out. So here's kind of like the benefits of forecasting, right? One of the big things I do when I'm working with our clients on forecasting is this time with them is really the first time that they're stepping back and seeing the big picture of their business. So they're moving beyond, doing the day-to-day working in the business, and they're working on the business when I'm working with them on this forecasting. They get to see kind of making those decisions of what we can do in the next 3 months. And really, it takes the time for them to take a step back and really put pen to paper as to what they want to do. If they want to buy new equipment, if they want to hire new people, what does those decisions look like in the financials, and where's their cash going to be after making those big decisions, or if they are able to land this client, what is that going to look like for their cash position, 3 months from now. So that's always a big thing, is to seeing the bigger picture of the entire business. And it's really easy to do when you have that meeting versus just feeling, your head down and you're just working in the business. The other big thing is the early warning system. So you're able to identify problems in advance and respond proactively. I will kind of discuss this a little bit more in one of our case studies, but it really helps you see, 3 months from now, where revenue is going to be, where our expenses are going to be, and kind of be proactive with seeing if there's any pitfalls that we're missing, especially if you're project based or you have contracts, things like that. Kind of going back to the first step here, strategic growth planning, you're able to do that modeling what if, right? So what if I implement this machine, or I implement that other machine, or if I hire these people and I'm able to generate some revenue off of these different projects? You can do that forecasting, and you can see that pen to paper kind of decisions of this is the different outcomes that can happen based on making my decision. So that at least helps you feel and make better, stronger decisions versus just saying, well, I would like to hire this person. This is kind of what I expect. But how is that going to look on your financials, and how is that going to play a bigger role into your business? And then we have the improved decision making, right? So based on forward-looking insights, not just on past data. So those are all the benefits of forecasting. Next, we're going to kind of go into the forecasting cycle. So the forecasting cycle, this is the cycle that I typically have with my clients. So they finalize, before the forecasting meeting, they finalize the month, and I import the updated financial data. I refresh the forecast based on the current sales trends and expected projections. Typically, I'm working with either the client's sales team, or sometimes it's the client themselves. I have access to some of their data, so I'm pulling that information based on some of the projects that they're working on, or some of the information that they have provided to me before the meeting. And then I have a forecasting meeting, which is probably an hour long. This is where I'm collaborating with them, and I'm refining the forecast based on their input. And so we're reviewing first the profit and loss, we're going through the balance sheet, and we're going through the cash flow. And this is where I'm providing, strategic advice and discussion action items of, whether we should go forward with these different items, whether it's, investing in new business, getting rid of things that we don't need as far as expenses go, all those kinds of different things that we discuss. And then post-meeting, I prepare a finalized summary of kind of like the forecasting report, so they can look at it. If they want to bring, someone, give it to one of their team members, their key management team members, they can look at it as well. But then I also put, those key takeaways, so they can review those key takeaways. But this is kind of like the forecasting cycle. There's always a pre-meeting, the meeting itself, and then post-meeting, and they're able to make those decisions based off that meeting. So I'm going to go into a case study here. This was a professional service client that we have. Initially, the client usually comes with a request to me, and they say, hey, I want you to do A, B, and C. And I would say like 9 times out of 10, that thing that they asked me to do is often the thing that kind of like gets them started, but it's never the end result of where we're at. I always try to deliver that initial request, but then there's so many other things that come out from that request that really helps them, and is kind of really what drives the forecasting, right? So initially they come and they ask me, I wanted to update this existing spreadsheet that was maintained by their office manager. I looked at the spreadsheet, and it was so detailed. It was too much information. They wanted to have it updated on a daily basis, and it was really kind of a cash flow spreadsheet. But there was too much detail. There was potential for human error of not entering in the right information. And the reason why the client did come to us initially was because the office manager made a mistake that costed him several hundreds of thousands of dollars um, in making that using that spreadsheet. And so he wanted to see, is there a different way to do it? And so I proposed a different method, and I proposed using a 3-month projection. He is a project-based professional service. So based on the projects that he's able to close and to fulfill on, we look at that time frame. And so using that forecast, we were able to figure out a couple different things. So we were able to strategically time out his distributions, knowing that he had enough money in his accounts to take his distributions to pay himself for personal expenses. The other thing that we evaluated based on where he wanted to go with his business was that we evaluated a potential acquisition from one of his vendors to buy out one of his vendors. And then in order for him to grow, he needed to invest in equipment. So we talked about intentional capital investments aligned with our growth strategy of growing the business. So it started with a little kernel here of, I want this spreadsheet updated, and it kind of exploded into this huge project of, forecasting and finding all these other financial insights that we were able to provide. So that's one case study of financial forecasting. This other one was a manufacturing client that we have. The banker required a financial forecast to support their continued financing. So the client received several purchase orders, and in order for them to continue the financing with the bank, they said, these are great. You have purchase orders in hand. I want you to kind of lay it out for me so I can take back to my board to see, how is this going to affect your business? Where's the profitability? And so in this case, we create a 12-month forecast, and we provided that to the bank, and so they were able to continue their financing going forward for their growth. And then from that request, we discussed, strategic debt reduction planning. So, what debt could we pay off that isn't kind of, bringing money to the table, right? So debt just for operations that we could pay down. We talked about targeted capital investments in equipment for growth. So they had all these purchase orders from new customers that wanted to get, product created for them, but they still needed to work on getting that equipment to continue their growth so they can fulfill those purchase orders in time. And then what really came from this was the profitability that they were showing based on the projection was significantly higher than they've ever seen before in their company history. And so I was able to provide really insights into their tax exposure based on doing that forecast. So we're going to have one more final polling question here. How likely are you to incorporate forecasting into your accounting process? So we got a poll here. I'll leave the poll open just a little bit more. Okay. I'm going to go to our next slide here. So we do have, you know, the last thing I was talking about on the manufacturing client was that we were able to provide, you know, foresight into kind of their tax exposure. And so the next webinar we have in our 3-part series on financial forecasting is discussion on using forecast to master tax strategy. That is October 30th at 2 p.m. So please join that. The link to sign up to register for that is on our website live right now. And then I'm going to go to questions. So let's see if there's any questions in the box here. All right. If you have any questions, you can ask them now if I can't get to them. So yeah, so I have this question here. Where can I sign up for a meeting with you to discuss forecasting for my business? So you can reach out to me directly. That's my email here on this slide. We could schedule a meeting to go over forecasting with your business. The other question is, can this be done using QuickBooks? So typically with the forecasting, we start with QuickBooks in terms of making sure all your data is correct, and then we kind of build off of that data. So we can create a model that's based off of QuickBooks, and then we'll project it out using that. So that's a great question. All right. So if you have any other questions, you can feel free to reach out to me in my email. I can happily discuss forecasting or budgeting with you. One of the questions is what type of saving strategies do you recommend to clients? Not sure completely what the question is in terms of saving strategies. Typically on the expense side, there's different saving strategies that you can do for that. But in terms of saving strategies, I'm not sure if that's saving cash or expense reduction. We could talk offline on that question. So if I haven't answered your question, I'll reach out to you via email. But this concludes our webinar. Hopefully you enjoyed our webinar on forecasting. Like I said, our next webinar is in October 30th at 2 p.m. Thank you.